40 years is a long time in asset management. It's long enough to experience multiple crises, paradigm shifts in markets, and a complete technological transformation of how portfolios are built, managed, and distributed. And if you've been part of the same firm for nearly 30 of those 40 years, you've not just witnessed that evolution, you've helped shape it. Today, we explore what 4 decades of independent asset management look like, the role technology has played along the way, and what it takes to scale internationally while staying true to a long-term investment philosophy. Hi, and welcome to Wealth Insider, a podcast by Performative. This is where industry meets insight, where we sit down for honest and engaging conversations with voices from every corner of the financial world. Together, we explore trends, strategies, and partnerships that are shaping the future of wealth management. Wealth Insider brings you closer to the people and the ideas that are driving the industry forward. Welcome back to Wealth Insider. I'm your host, Christian Lindvall, Global Commercial Director at Performative. Today, I'm joined by Bo Almar Knudsen, CEO and Portfolio Manager at WorldWide Asset Management. Bo has been with the company for almost 30 years and has served as CEO since 2012. I think few leaders have had the opportunity to grow with the firm for that long and then go on to lead it on an international stage. Bo, welcome to the show. We're thrilled to have you. I think probably a good place to start, though, is maybe getting a background in your career and then sort of long-term perspective. So you've spent nearly 3 decades with WorldWide. You also had a stint at, I believe, Nordea and Danske, and then came back to WorldWide and have been the CEO since 2012. Can you kind of take us through that career journey and some of the inflection points along the way?
Certainly. Thank you very much for inviting me, and it's a pleasure to be here. Well, I started at university and started my first job in the investment management industry. So I'm lucky to have been part of the industry for 37 years now. And I came with the belief that it was possible to calculate my way to success. So my background was, I had some quant in my educational years, but basically quickly found out that it was not so much about calculations. It was about understanding human psychology to a much larger extent. And this ability that humans have to create reality. And eventually that is quite hard to put down on an algo, put into an algo and calculate your way into success. So that was my first experience in the first few years. I came with a lot of bara knowledge and a lot of quant beliefs that, and I found out that, it's not that easy. It's not that, that's not necessarily the only way to be successful.
Yeah. All right, so you've also worked, as mentioned, at Danske Bank and Nordea, and I want to go back to those two just for a second because I'm curious, working at big institutions like that, what sort of experiences did you have there, and what did it teach you about maybe investment philosophy and also the leader you've become today?
I like to look at life from the positive side and look at all of the positive things that I got out of that. And it was crucial to understand that the big banks have are not similar. There are big cultural differences from one bank to another. I think that's important. And at the end of the day, it is about humans and human relationships. So. But obviously, when you work in a big bank, you also get respect for all of the facets of running a firm, and you get a deeper understanding of some of the most important players in the industry. It is, I think, fair to say, and it's fair to generalize that it can be a bit more difficult to take active risks when you are part of a big organization and a bigger bank. And obviously our firm has been built on and is building on the foundation of taking active risks and that being the core part of our business model. Yeah. So a lot of learnings. At the end of the day, it's about human beings.
I think we'll get to that in the technology section because I'm really keen to dig in, but I think it's really interesting. You were saying it's about humans, it's learning about human psychology, and I think that, at least from my perspective now being in the space, that's going to really set apart someplace like See WorldWide. That, like, yes, there's a lot of technological advancement, AI, all the buzzwords, but if you don't have the human touch and you can't connect with your customers, I think that's probably not sustainable long term.
I would definitely tend to agree with that, and let's dig into all of the great stuff about the asset management industry.
Yeah. So I think congratulations is in order because I think this year marks the 40th anniversary of See WorldWide Asset Management.
Yes.
So congratulations.
Thank you.
I think that's fantastic. It's a fantastic achievement to be around that long and still relevant and growing. When you reflect on the firm's development over the last 4 decades, what are the defining moments that have shaped how you've evolved and grown the business?
The foundation of the firm focusing on few products with a concentrated portfolio of equities has been with us for 40 years. And we have received a lot of advice. You have to diversify. I think that it is defining for us, it was and is defining for us to actually make that choice and really believe that you have to focus to succeed. Yeah. So we've held on to that, and I think it's been the right choice. You can always claim that you could have done something else, right? But I think that there's so much power in being focused in highly competitive businesses. On top of that, early on in the lifespan of the company, we were fortunate enough to get institutional clients. And that has shaped us and is shaping us today. And the principle was, if we can live up to the most advanced institutional clients, we can live up to most client demands. So that has been a defining a decision and a defining for the firm. So here we can go all the way back to the 90s, where we were fortunate enough to get some big Danish institutions. Then there's the second big thing that I would like to highlight here was the decision to go international.
Right.
So we basically took the decision just before the great financial crisis, and in 2006-07 started to look into the London market, and also established a relationship with a Canadian firm that opened doors to institutional clients there. And it's been a very interesting development. We've been able to get a solid footing in Australia, in Canada, in the UK. And then another defining moment was when we decided we want to be able to walk down Fifth Avenue and said we also have a solid client base here. And so back in 15-16, basically 10 years ago, we took the decision to also move into the biggest of the asset management markets, the US. So that those institutional, the focus, the institutional decision being relevant for institutional investors and going international, focused areas, not the whole world, but focused international expansion. Those 3 decisions have been really defining for the firm.
Maybe to dig into the international expansion, because I'm really curious on this. It's a big risk in many ways. To do that, was there a trigger that made you go in 2006, okay, the UK market makes sense, Australia, so on and so forth, and then of course 10 years later, it sounds like you also went into the biggest market in the world in that sense, in the US. What was the trigger initially to go international? Did you see something on the market that you just thought, now's the time?
Yeah, so the trigger was us experiencing competition from international managers moving into the Scandinavian markets. that we consider definitely to be our home base, because that's where we're born and where the business and the operations are primarily located. But it was the competition coming from outside, but also actual genuine interest. I'd say if it weren't for our first client in Australia, I'm not sure that we would have ever gone into Australia. So we had one big institution in Australia that thought that our process and the way we manage money was really interesting. And after a classic 3-year due diligence, they actually funded us in 2010, and that opened up for Australia. So it was primarily us opening up and saying, well, our approach fits especially Anglo-Saxon markets, 1 and 2, a genuine interest from specific clients and consultants. We have never been a company that has been driven primarily by sales. We are a group of stock nerds that likes to find great stocks worldwide, and that's the core, the passion for stock picking, and that has over time attracted interest.
40 years is a long time across markets, products, and competition, and those things have changed greatly, you could say. So I'm curious to know what core principles have remained consistent over that time.
There's one key word. You could say quality is in the understanding of the word quality is in the eye of the beholder, but quality from the perspective of us wanting to deliver a quality experience for our clients. What is that? For us, it's very much also investing in companies that we consider to be sustainable, compounders, companies with years, decades ahead of them. And quality, if we take it one step further, it's not just about high returns on capital. It's also features that you can't necessarily measure in numbers. So we prefer companies that have a strong competitive positioning. We call them companies with domain expertise.
Yeah.
And the combination of companies with domain expertise and scale, leading market positions, that combination is something that we're very interested in. And typically these companies would have qualities like high returns on capital, high margins, low debt levels, and those types of names is typically the core of our investment universe. Then on top of that, we like to have companies that have thematic support. So, and thematic support for us is not the next quarter that there's something interesting going on for the firm or the area that and the competitive arena that they are playing in. It's more 5, 10, 15-year shifts. So when I joined the firm in 94, we talked a lot about aging population, and here we were in the earlier years of globalization as well, 2 massive changes that have formed reality, economic reality for decades now. Now, one theme that we see having staying power is is more the rise of the nation state. Globalization is changing. It's not dying. It is changing and becoming more regional. But the nation state gets a much bigger role and plays a much bigger role. So the thematic element and the quality there, the feature there, I think is timeless. The dimension of finding something that at least, if not timeless, then at least has some staying power for 5, 10, for sort of a decade-long theme. So we're trying to identify that, combining that with companies that have domain expertise and scale and longevity.
I think probably associated with that longevity, there needs to be sort of an incredible amount of research done on that, but also patience if you're looking at it over 10, 15 years. So have there been any times where you've bet on something, made a pick, and you're like, we maybe made the wrong pick after 2 years, but then it turns out, 5, 7, 8 years later, it actually was the right pick?
This is now if you have problems being humble, I suggest that you start in the investment management industry because it's a humbling experience. Now, it's not just finding the right company that does well, and that feature, that quality is often priced in the market as well. So you can't talk about investments without talking about the valuation component. And what you're exactly referring to is you risk buying a concept that is well regarded. But I think one feature that on average has helped us is trends last longer than you think. And we have that experience in mind when we invest. So we are more patient than the average investor. And the average investor, with all due respect, is less patient than ever. And there are certain changes in society that are changing the perspective. Gamification. I have 3 sons. They've all been gamers, and they can be long-term, but there is a line of thinking where you have your feed, you are exposed to disturbing elements. Things are running faster now, definitely, with more question marks around the quality sometimes of the information that you receive. And this is also reflected in markets. So patience is key, and that has helped us on average over the years.
All right, so maybe drawing back to the fact that, again, you're based in Copenhagen. We talked a bit about how you operate internationally and the trigger to go into those markets. But what does it actually take to build and run an international asset manager while also staying rooted in sort of home country, home market where you started?
It's a good starting point to build the firm in an environment, actually in countries and in the Nordics, where there is a tradition of having an international orientation. We are small countries, and early on, in the development of our firm, we found that just limiting ourselves to the Nordic stock markets, too narrow. Mm-hmm. And again, a solid client base. But if you want to grow in a controlled way, you need to look outside of your home. So there's a cultural aspect in seeing the world as your opportunity. You have to have that mindset, and I think it's more easier coming from a small country, actually.
Yeah, that makes total sense.
So that would be definitely one element of it. But I would also highlight one other thing, and that is the importance of partnerships. Working together with individuals and teams, organizations that are operating locally and in different time zones. So we have not built our own base of people in Australia and in the US. We work with partners. And the longest lasting partnership turns 20 years this year.
Wow.
In Canada. And we've also had long partnerships in particular in Australia, and now also starting to build longer partnerships with individuals and teams that help us and introduces us to new clients and help managing existing client relationships. So partnerships. And then respectful partnerships, long-term partnerships, has been absolute key.
Yeah, I guess maybe speaking to the partnerships, which seem to matter a lot, but I think there's still this thing you need to contend with around cultural differences. Certainly, Canada is different than the U.S. U.S. is very different than Australia.
Yeah.
U.K., I would say, very different than the Nordics. So when you serve clients across all of those different regions, I assume there is, some nuance in how you lead across, those sort of international markets.
We really have. We get a lot of help there from our local partners. The advantage here is that across the geographies, we work with institutional clients. And we work with individuals, teams that also have a global mindset. So I think that at the end of the day, it's about human relationships, respectful human relationships. And hence, I don't see such a big issue here, actually. There is we speak a certain language, and that there's a certain language that is shared, because of the common goal, and also the institutional and fiduciary responsibility that we all share.
I have a question about your role as a CEO. It's also stated CEO and portfolio manager, so you're still in it every day, but then you're also managing teams sort of across the globe. How thinly are you stretched every day? Are you traveling a lot?
Yes. So I'm the only, we've been in operation for, as you highlighted earlier, 40 years. I'm the only second CEO of the firm. And the first CEO was also CEO and portfolio manager. So I have continued that tradition. Now, we built a structure where we have very strong operational people that take their own decisions, that have been with the firm for a very long time. We have an unusual number of individuals that have been with the firm for a very long period of time.
Which is rare anymore.
It's rare in this industry. I think we are at the top if you look at it, at these statistics worldwide. And so my point here is that you have to be ready to share responsibilities and be very comfortable in giving out responsibilities to other individuals. You can't control everything, and there's a lot of trust involved here. And then at the end of the day, of course, the responsibility ends with me in the organization. But I have so much trust in my colleagues, and that's how we can manage. Again, we work with partnerships and individuals at the end of the day. So there are a few individuals that take responsibility aside from me, and that's how we can make this work.
Yeah, make it all work.
And just a final comment. It's for the culture of the firm. It's been important, and it is important for us to have investments as the main priority. So if you have a CEO that is involved in and on the investment side, compared to an individual and a CEO that has a a more financial orientation, a more client-oriented, sales-driven orientation, well, that feeds through the whole organization.
Yes.
And this industry is so delicate, so competitive. If we want and we need to deliver investment success, you need to be very delicate also about the prioritization of what's going on. And we have chosen that there are pros and cons in everything, to have the CEO and the person that is also involved in the investments as the same person.
I think it's fantastic ethos to drive forward. So, yeah, was just keen to hear your perspective on it.
It's a very good question.
Yeah. I think now would like to maybe pivot toward technology and maybe how it's impacted WorldWide and the sort of evolution of the business. If we go back to mid-90s, the tools available to portfolio managers were very different, probably very analog in comparison to what is available now. How has technology changed the way in which you research companies and maybe make investment decisions today?
I would say it hasn't changed that much, actually. So everything is faster. And you have to be these days more critical about the information that you are getting. But you get more information. So back then, definitely less information about a company. Today, more, but you have to be more diligent in sorting what's right and wrong. But at the end of the day, for us, successful investing is figuring out what is important. So one of the problems with technology and access to so much information is information overload. That it becomes harder to distinguish what is important or not. And I've come across, I've met many of the most successful investors in the world and continues to meet and respect a lot of great portfolio managers out there. I have not seen a direct correlation between a person that impresses me with detailed data and performance. So this capability of being able to figure out what is the 1 or 2, 3 most important things over the next coming years, that is in a way timeless.
So that still takes intuition, maybe gut feeling, and all the knowledge you've gained over 40 years. That still matters today, even in a technologically advanced world.
I need to believe in that. I have no alternative. I'm biased here, of course, but I believe that fundamentally it also makes sense. Now, the markets of today compared to 20, 30 years ago, the markets today are much more driven by index investors, and on the margin, the retail factor is also more important. So there are more short-term money moving the needle today compared to earlier. But at the end of the day, so trading is more important today. It's a bigger part of volumes today compared to investing, if you will, with the difference being the time horizon. Mm-hmm. But we have to remember that at the end of the day, when you buy a company, you actually buy a value-generating, dynamic, living organism, an organism, an entity that creates dividends, cash flows. So at the end of the day, there is a link, and there has to be a link between the stock price, the market value of the firm, and what that entity creates in economic value. If you eventually you can go out and you can borrow money and buy the whole company and then get your money back and a bit more. So at the end of the day, there has to be a link between the economic value and the stock price. And I think that's important because sometimes, and not least the last couple of years, it's easy to just believe that it's all about trading now. There's no point in being long-term because everything changes so fast. But here, I'm not repeating my thesis or my comment here, just saying that you buy an economic asset with value-generating capabilities, and that has to be linked to the economic value of the market value of the firm on the stock exchange.
Yeah.
So this is key for us, being fundamental in our orientation. That hasn't changed for 30, 40 years.
No. And maybe last question then on technology. From a business perspective, how has it actually changed, though, how an asset manager maybe operates in areas like risk management, trading, but then also really importantly to client communication, reporting, et cetera? I assume it's gotten easier, better for the customer, the end customer as well.
Yes, obviously much higher levels of transparency and quicker reporting. And definitely in many ways good. And now there is the difference, there's this very clear difference between even quarterly reporting back in the 90s, quarterly reporting of performance data versus day-to-day performance now. Our clients know by the day how we perform with our reporting, but also with their own systems. So, of course, you measure a lot more, and this could lead to short-term worries, short-term behavior. And I think that this is something that you have to fight. Like you have to some extent, benefit from the feed, but you also have to be aware of the effects that it has. So risk management, compliance, the level of transparency has increased dramatically. And I think that's overall very well and very good. So the backside of it is just you simply get too short term.
Yeah, you have to mitigate that sort of short-term concern.
Exactly.
Yeah. All right, so I have kind of a long question for you. So you are well known for long-term unconstrained stock picking. There's so much data in the world, automation, and a lot of new systematic approaches. So how do you define the role now of human judgment and conviction in your process today, which I know is important for you?
You can look at technology in many different ways, and obviously we're now exposed to very powerful tools under the heading of AI. Fundamentally, I believe in iterations. I believe that when you take decisions, you want to iterate your way through a decision-making process and then eventually take a decision. And I see AI as another very good speaking partner in the iterative process. In many instances, I'm deeply impressed. It's also a speaking partner that has its biases. For example, I think it's generally known that at least some tools want to agree with you. Mm-hmm. So in many ways, it's similar to having a discussion partner. But I'm very pleased that we now have this extra dimension and a new partner to iterate with. But at the end of the day, decision making lands on the human, at least in our setup. we are fully aware that we compete with. There are competitors out there that puts a lot more emphasis on what comes out and what technology brings and whatever tools they use. That there is more competition out there, and I think in the short-term world, in the world of arbitrage, I think it's very, very difficult to be a human being these days. But in the world of long-term investing, I'm just very pleased that we have another partner to speak with. And I think we will take better decisions in that setup. We also know that our competitors are going to probably take better decisions. And our differentiating factor would be us taking a longer time horizon, taking a longer perspective, and hopefully being able to focus on what we find to be the most important thing compared to others. So there's a market, there's a buyer and a seller out there, and I don't necessarily see technology leading to a more necessarily rational world, but more competition, also more opportunity. Because there is an invitation to technology to drive a shorter-term thinking.
Yeah. Maybe that's a great place to end then with one last question, which is pace of change is dramatic, I would say right now. There's lots of competition, but you also see it as an opportunity. So for maybe the next decade for active managers in the space, what do you think is going to be most important? And then how is WorldWide sort of adapting to that 5 to 10 year worldview in this space?
Yeah, I think the biggest danger is to become too short term. I think it's a very difficult arena to battle in, and I would go for another arena, and where competition is less crowded, and that is in the arena of thinking about the long term. And we fortunately have 40 years of experience in identifying key factors that matters over 3, 5, 7, 10 year time horizons. So we want to stick to that. We will use the tools that technology gives us. I think it's important to hold on to that core, and I think that the environment that we are in are giving us opportunities here. It's back to what we talked about earlier, sometimes very humbling, and being patient is also sometimes looking a bit out of sync. And it's not nice as a human being to be looked at as being out of sync. We are herd animals. That's what we are well trained in, and we want to hold on to that.
Perfect. Bo, thank you so much for joining us today. I thought it was a great conversation and hope to have you back someday soon.
Thank you very much. It was a pleasure.
That's it for today's episode of Wealth Insider. If you enjoyed this conversation, be sure to subscribe to the show wherever you get your podcasts. You can also find more insight on performative.com, and we'll be back soon with more conversations from the people redefining wealth management.